Hi, my name is Jack Silver.
Yeah.
I'm chair of the Chicago Teachers Union Pension Insurance Committee, and I'd like to welcome you to this educational webinar, pension educational webinar, that's co-sponsored by the Chicago Municipal Pension Fund and Chicago Teachers Union and the Chicago Teachers Union Pension Insurance Committee. Before we start, I'd like to give thanks to the officers of the Chicago Teachers Union for helping sponsor this event. And I also like to thank the people involved at the Chicago Municipal Pension Fund for helping us with the contributors who are also members of this fund. Today we have Mr. Latif Moody. He's a senior pension benefits counselor at the Chicago Municipal Fund, who will be doing the presentation. Before the presentation begins, I'd like to let you know that questions will be taken after the presentation, and Mr. Moody will be happy to answer your questions. And also, if any of you would like to join the Pension Insurance Committee, please email me. My email is jacksilver1@gmail.com. jacksilver1@gmail.com. Okay, I'd like to introduce you to Mr. Latif Moody now, and hope you enjoy the presentation.
All right, thanks a lot, Jack. So hello, everyone. Thank you for your attendance today. We want to welcome you to our pre-retirement session. What do you know about retirement? Presented by the Chicago Teachers Union, along with the Municipal Employees Annuity and Benefit Fund of Chicago. So allow me to introduce myself. My name is Latif Moody. I am a senior pension benefits counselor in the benefits department of the fund. So the first thing I'm often asked is, how do I know when I'm eligible to retire? Well, eligibility is defined by which tier you are in as a member of this pension fund. So there are 3 tiers with this fund: Tier 1, Tier 2, and Tier 3. And your start date defines which tier you are in as a member of this fund. So first, if you were hired prior to January of 2011, you are a Tier 1 member of this fund. So let's go over the eligibility criteria as a Tier 1 member. So if you are age 50 with at least 30 years of service, you are eligible for an unreduced pension benefit upon retirement. If you are age 55 with 20 years, you're eligible for a reduced benefit. And later on, I'll show you examples of each. I'll show you an example of a reduced pension benefit versus an unreduced benefit. Also, if you are age 55 with 25 years of service, you're eligible for an unreduced benefit, along with being age 60 with at least 10 years of service. Now, pension contributions are breakdown this way. So there's a total 9% pension contribution coming out of every paycheck from you. And also very often there is a combination or what's called a CPS pension pickup involved also. So typically there's a split of you contributing 2% and CPS contributing 7% to make a total 9% pension contribution. Now, there can be some positions in which that split is 4%, 5%, where you're contributing 4% and CPS is contributing 5%, once again, totaling that 9% pension contribution. There is also, in order for a pension calculation, we use a 4-year final average salary. We take the highest 4 consecutive salaries out of your last 10 years and average those in order to calculate your pension. And I'll show you examples of that final average salary calculation later on as well. Now, if you were hired for the first time between January 2011 and July 5th of 2017, that makes you a Tier 2 member of the fund. Now, Tier 2 eligibility is very different than Tier 1, and so is Tier 3. Here's the breakdown of Tier 2. So if you are age 62 with at least 10 years of service, you're eligible for a reduced benefit. And if you are age 67 with at least 10 years of service, you're eligible for an unreduced benefit. And once again, there's a 9% pension contribution. Once again, the typical split is 2%, 7%, or 4%, 5%. Now, another big difference with Tier 2 versus Tier 1 is that there is an 8-year final average salary breakdown or calculation. So we take the highest 8 consecutive salaries out of your last 10 years worked versus a 4-year average for Tier 1. And Tier 3. Now, if you were hired for the first time on or after July 6 of 2017, you are a Tier 3 member of the fund. Now, you'll notice here that the eligibility for Tier 3 of age 60 with 10 years for a reduced benefit and age 65 with 10 years for an unreduced benefit, it's a little bit younger than Tier 2, where there's a bit of a trade-off happening. Tier 3 members are able to retire a bit earlier than Tier 2 members because they contribute more. As you can see here, Tier 3 members, for them, there's a 12% pension contribution. The typical split is 5% of the member and then 7% of CPS, making a total 12% contribution. So they can be more earlier than Tier 2 members. And once again, there is an 8-year final average salary calculation, just like the Tier 2 members. And just to note, today's presentation is primarily geared towards Tier 1 members, but if you are a Tier 2 or Tier 3 member of the fund, please still stay tuned because there's going to still be a lot of really good information for you if you are a Tier 2 or Tier 3 member of the fund. Okay, so now let's talk about the topics for today. So of course, we're going to talk about pensions, once again, getting into the eligibility and criteria for retirement. Refunds. There can be situations where you may separate from service, but you're not eligible for a pension. We'll talk about your options in terms of benefits if you only qualify for a refund of your pension contributions. Another topic is reciprocity. So you may be able to combine your service credit with this fund with service credit under what's called a reciprocal pension fund. So I'll break down reciprocity. Another topic, and this is kind of a popular one, is the cost of living adjustment after retirement, or the COLA. So we'll talk about your annual raise after retirement. Surviving spouse annuities is also a very important topic because, of course, many of you want to know what kind of benefits are your spouse is entitled to, or is your spouse entitled to upon your death. We'll also go over another important topic, disability benefits. Also, I'll show you several examples of how your pension is calculated. And I'll take you through the application process for applying for retirement. And then a kind of a little known topic of what's called the reversionary annuity. You may not have heard of that before, may not be familiar with it. So I'll give you some information on that. Okay, so before we get started with those topics, I need to read our presentation disclaimer. So this presentation was created by our fund to make available general information about the benefits provided. So the main thing that I want you all also to keep in mind today is that this is good general information, but you shouldn't simply rely only on this presentation for retirement information. This presentation is not a substitute for calling our office and speaking to a pension benefits counselor like myself or another counselor and getting your questions answered and requesting a pension estimate. It is very important to do that and not just solely rely on a presentation like this. Next, the Illinois Pension Code, or the law, enacted by the Illinois General Assembly, is the official authority and primary reference source regarding this pension fund. If there is any conflict between this presentation and the law prevails. Next, the information contained in this presentation is summary in nature and does not include all conditions, limitations, or exceptions that may be applicable to a particular situation. Every effort has been made to present current information without inaccuracies. However, errors, additions, deletions, and changes in the laws governing this fund or the procedures utilized to administer these laws may occur and could make certain information out of date or inaccurate. Therefore, anyone who reviews this presentation is advised of their responsibility to contact our fund directly for specific information relating to benefits and to confirm the accuracy and completeness of the posted information. Once again, it is your job to contact our fund to obtain specific information on your account and your retirement eligibility and pension benefits. And also, the fund has no liability with respect to any actions taken as a result of or in connection with the information contained within. So first, if you join the fund, started before January of 2011. If you're between the ages of 50 and 54 and you have at least 30 years of service, you are eligible for retirement. If you are between the ages of 55 and 59 and have at least 10 years of service, you are eligible for a benefit. And if you are age 60 or older with any years of service, you are eligible for a pension benefit. Now, the first type of benefit I want to talk about is a money purchase benefit. So a money purchase benefit doesn't happen often, but it is something that we want to make you aware of. So if you're between the ages of 55 and 59, and you have at least 10 years of service, but less than 20 years of service, then you are eligible for the money purchase benefit. And if you are age 60 or older when you separate from service and you have a less than 10 years of service, you are also eligible for the money purchase benefit. Now, the money purchase benefit it's essentially a lifetime expectancy calculation where we take your age and the amount of money you've contributed and calculate a benefit based on how long you are expected to live. Now, the downside to this benefit is that it typically is only a few $100s a month, $200, $300 a month. So it's not, like I said, at all the ideal situation. And another stipulation about the money purchase benefit is that it may not be for life. It might only be for a certain number of years. So this, like I said, most members do not fall into this situation, but if you can avoid the money purchase benefit, you want to avoid that because, like I said, the money purchase, it's an option, but it is not the ideal situation. Okay, so now let's talk about what happens to most members when they retire. Their pension benefit is based on our minimum formula, and I'll tell you in a second why it's called the minimum formula. It's based on 3 factors. The first one is your age. Next is that 4-year final average salary. Once again, highest 4 consecutive salaries out of your last 10 years worked. And your years of service, the time that you have paid into this pension fund. Okay, so the one thing that's a common misconception is that members think that their service credit is tied to the anniversary of their start date. I hear that all the time, and I have to let members know, well, that's not how we calculate service credit. Here's how service credit is calculated. So the first thing is that if you work at least 1 full month in a calendar year, so for example, if you work the entire month of January, you don't miss a day, an hour, you work the entire month, you actually receive your first half of service credit for that year just by working all of January. So that's a pretty nice benefit. And if you work 6 months in the calendar year, January through June, for example, you actually receive your full year of service credit in June. So every year, and it's going to happen again next month, we process a ton of retirements for people that retire June 30th, because they understand that pension-wise, there's nothing to be gained by retiring in November or December at the end of the calendar year. So a ton of members go ahead and just retire in June because they understand that their pension is set for the year already, and they're not really gaining anything by staying until later in the year. So yes, every year, if you work January through June, you earn your full year of service credit for that year in June. Okay, so now let's discuss why this is called the minimum annuity or the minimum formula. So if you separate from service, and I tend to say, just backtrack for a second, I tend to say separate a lot because sometimes members believe that if they are fired or terminated from a position, that somehow affects their benefits, but it doesn't. Your benefits are the same no matter whether you leave a job voluntarily or not, because let's be honest, sometimes we don't always leave a job voluntarily. It happens. So I say if you separate from service at least age 60, and if you have at least 10 years of service, you qualify for a minimum pension of $850 per month for life. Now, just to be clear, I don't want to scare anyone. I'm not saying that if you retire with 30 years of service, you're only going to get $850 a month for life. I'm not saying that. What I am saying is that that's the minimum amount that you are entitled to if you retire at age 60 or older with at least 10 years of service. You're entitled to at least $850 per month. Okay, so now to go from the minimum benefit to the maximum benefit. So the maximum benefit, you have to be at least 50 years of age or older to be eligible for retirement. So with this pension fund, you cannot retire earlier than age 50. Age 50 is the earliest that you can retire. So if you are at least age 50, and if you have 33 and a half years of service, then you are eligible for the maximum pension benefit. The maximum benefit in our fund is 80% of that 4-year final average salary. So it's a pretty straightforward calculation. We just average out your best 4 consecutive years, and we take 80% of that, and there's your pension. Okay, now another option is what's called deferring your pension. So these could be situations where if you have at least 10 years of service in this pension fund, so it takes 10 years of service to be what's called vested. And vested means that you are eligible for a pension once you meet the age requirements. So, for example, someone who separates from service at age 51 with 25 years of service, well, they've got 25 years, but they're not age 55 yet. So they're not eligible for pension at that point when they separate from service. So if you're age 51 and you have 25 years of service, you can choose to defer your pension until the age of 55. So you can leave your contributions here, and then you can simply collect your pension at age 55. Or there can be cases where, let's say, for example, you're 55 and you have 17 years of service. Well, let's say you don't want the money purchase benefit that I went through, you want the minimum formula benefit. So at age 55 with 17 years, you can choose to defer your pension until age 60. So you definitely have the option of doing that. If you separate from service and you've got the years, but you don't have the age, you can absolutely defer your pension until either age 55 or age 60, whatever's going on in your particular situation. You can even defer your pension if you're eligible. So let's say, for example, age 55 with 20 years of service. And as I mentioned earlier, age 55 with 20 years is a reduced benefit. If you want to avoid the reduction, you can choose to defer your pension until age 60, because at age 60, there is no reduction. I'm going to show you some more information on that later on. So you absolutely have the option of doing that also. Now, I do want to make one thing clear about deferring your pension. And I had another example of this just 3 days ago, back on Monday. So if you separate from service and you choose to defer your pension, let's just say, for example, until the age of 55, what you should do in a case like that is contact our office and submit a retirement application to our office 2 or 3 months approximately before you turn either age 55 or age 60, whatever your particular situation is. The reason for this is, and this happened 3 days ago, I spoke to a woman who turned 55 last August of 2020. Well, she didn't apply for benefits back then. She just called 3 days ago. Well, the unfortunate thing for her is that in situations like this, where you choose to defer your pension, but you don't apply on time, or you don't apply a few months before you turn age 55, in her case, the benefit is then not retroactive. So she could have applied last year and should have applied last year. So she turned 55 in August. Now, the pension fund doesn't give partial month benefits. So if she'd applied on time, her benefit would have started in September. So at this point, she has lost out on 11 months of pension because she did not apply last year as she approached her 55th birthday. She just called now. And when I've informed her of that, of course, she was devastated to have now lost out on thousands of dollars because, like I said, her benefit cannot be retroactive. So it's very important that if you choose to defer your pension, that you apply a few months before you turn either age 55 or age 60. Because in her case, I urged her to turn in the application as soon as possible because, like I said, she's already lost out on a year because it's too late for her to get a July pension check. Unless she turns in the application by tomorrow, it's going to be too late to get an August check. So she very likely is going to be looking at pension in September. assuming she turns the application in. So she's lost out on a whole year of pension benefits. So I want to make sure that you all are aware of that. So one thing I want to make very clear today is if you are going to separate from employment, please call our office before you separate and review your benefit options with us, because you do not want to be in her situation of saying, well, I didn't know, nobody told me. And I said, well, okay, yeah, but you didn't call our office, so she didn't know. If she had called our office a year ago, she would have known. Okay, what other note about deferring your pension? Any contributions that are left here while you choose to defer your pension do not gain statutory interest, which is 3%. The interest rate here is 3%, until they're used for pension purposes at a later date. Okay, so next the topic here is refunds. Now, when it comes to refunds, as I mentioned earlier, you might want to be in a situation where you separate from service and you don't meet the 10-year requirement for pension. You're not vested, as I was saying earlier. So you separate from service with less than 10 years. Well, if you find yourself in that situation, you are eligible to apply for a lump sum refund of your pension contributions. Now, one thing I want to make clear about taking a refund is that there's two big stipulations involved with taking a lump sum refund. The first one is that if you take a refund of contributions, you forfeit your years of service. And I talked to a lot of people that wind up working back at CPS years later after they've separated and taken a refund, and they weren't aware of that. And so they had 15 years of service, and they took that refund, and those 15 years are gone. So now they're back at CPS, and instead of having 18 years of service, they only have 3 years because they lost those 15 years when they took the refund. So be very clear about that if you take that refund, you are forfeiting your service credit. The other big stipulation is that if you take the refund, you are not entitled to any future benefits from the fund. You'd be surprised, but I have the occasional conversation with someone who will call in and say that they want to apply for pension benefits. But then when I pull up their account, I see that they're not a current employee, and they took a refund. They separated and they took a refund. And I have to explain to them that there is no money here for them because they already pulled it out. So be very, very clear what the consequences are of taking a refund. And another thing to note is that, as you see here on the screen, the pension contributions include statutory interest, once again, 3%, only up until the date you separate from service. Another common misconception that I've heard over the years is members think that if they separate from service and leave the money here for 2 years, 3 years, that it's going to gain interest during that time. That does not happen. So if you separate from service, you're not eligible for a pension. The interest stops at the date that you separate from service. So you can choose to leave the money here. You don't have to take the pension, the refund right away. But if you do choose to take the refund down the line, just be very clear that your contributions do not gain any interest after you have separated. Okay, so another thing to talk about is pension eligibility. If you separate from service and you are pension eligible, let's say that it's a situation where it's a money purchase. Well, let's say it's someone who is age 55 and they only have 12 years of service. So in a situation like that, they are eligible for the money purchase pension. And if you are separated from service and are pension eligible, and if your pension is calculated to be less than $800 per month, you do have the option of taking that lump sum refund of contributions instead of taking the monthly pension. You do have that option in that scenario. Now, conversely, if you separate from service and you are pension eligible, and if your pension calculation is at least $800 per month, you are not allowed to take a refund. You have to take the pension. Okay, another topic. So if you are legally single at the time that you separate from service, you will receive a refund of your spousal contributions upon retirement. So I need to define something, and it's kind of funny, but I need to define this. So let's talk about what legally single means. Legally single means never married. Legally single means divorced. Legally single means widowed. Legally single does not mean you are married and you haven't seen your spouse in 15 years. That is a common misconception with members, that they think that they should be entitled to their spousal contributions because they consider themselves single because they're married, but they are completely estranged from their spouse. So no, you only receive the lump sum of the spousal contributions upon retirement if you are legally single. Okay, so with those refunds that I just described, either situation, the spousal contributions refund or the refund of contributions, either situation has tax implications. So any taxable portion of a refund that is not rolled over into a qualified tax deferred plan is taxed at 20% off the top. Now, these are IRS withholding rules. This is not the pension fund. So the 20% is taken off the top of any refund that is taxable and not rolled over. And in addition to that, if you are under age 59 and a half at the time that you take the refund, there may be an additional 10% penalty when you file your taxes the next year. So these refunds are heavily taxed. Okay, so as I mentioned earlier, if you separate from service and you decide to take a lump sum refund of your pension contributions, but then you find yourself working at CPS again sometime down the line, and this happens a fair amount, you do have the option of repaying that refund to our pension fund and regaining those years of service that you lost when you took the original refund. You do have the option of paying that refund back. But one thing to note is that you must pay that refund back within 90 days of you separating from service again. So if you believe that you have refunded service with our pension fund, absolutely give us a call. We can look up your account and we can send you a bill to repay that refund. I also want to note that any kind of refund repayment does involve interest. So you've got to pay that refund back with interest. Okay, so now let's talk about reciprocity. So as you can see here, there are about a dozen public pension funds here in Illinois that fall under a piece of legislation called the Illinois Reciprocal Act. It's almost every public pension fund here in the state, except the police department pension fund and the fire department pension fund. So if you have at least 1 year of service in one of these other pension funds, so let's just say, for example, you have 18 years with our fund and you've got another 2 years with my friends at the Chicago Teachers Pension Fund, and you're trying to meet you're 55 years old, you're 60 years old, and you're trying to meet the 20 years of service requirement, you could take your 18 years with our pension fund and your 2 years with the Chicago Teachers Pension Fund and combine them together essentially. And then combined together, you meet the 20-year requirement for pension. And so then you would complete 2 retirement applications or more if you're retiring under more than 2 pension funds. And then each fund would pay their portion of your pension. So that's called retiring under reciprocity. It can be a very, very nice benefit. Another thing to keep in mind too is that when I was talking about refunded service a second ago, if you have worked under or contributed to one of these other pension funds, and if you took a refund from that pension fund, you could choose to explore repaying that refund to that pension fund and then combining the service together and again retiring under reciprocity. So it may be worth your while to reach out to one of these pension funds if you believe you have service with them or refunded service with them. And if it's refunded, you could contact them about potentially paying the refund back to them if it's at least 1 year of service. Another note about reciprocity is that what's called concurrent service cannot be used or is not awarded. Now, what do I mean by that is, last week I had a gentleman call me, and he's currently a CPS employee, so he's currently a member of this fund, and he's about to accept a position with the state where he would become a member of the state employees retirement system. So I let him know that he can do that, but he cannot combine the time together under reciprocity, because if he takes this job, then he's going to be contributing to 2 different pension funds at the exact same time. So that can't happen where you can't combine the service together. If he works enough years with his state job, he would have to pursue a separate pension benefit with them. He couldn't combine that service with our fund. Okay, here's a happy topic, COLAs. So the COLA, or the cost of living adjustment, or what's called the automatic annual increase, it's got a couple of nicknames, but I tend to hear the phrase COLA more often than not. So the COLA begins The date that the COLA will begin is entirely tied to your age at retirement. So if you retire at least age 59, and as long as you retire by November 30th of that year, you are entitled to begin receiving a 3% annual raise on your pension the January after you retire. So for example, anyone who retires this year who is, let's say someone is age 59, and they're going to retire this year, as long as they retire by November 30th, they will begin receiving their annual raise this January of 2022. Now, there's this weird accounting rule where if you're 59 years of age or older and you retire in December, your 3% raise is delayed a year. You essentially lose out on the first year of it. So if somebody is 60 years old and they retire this December, they will not get a COLA until January of 2023. They will lose out on the 2022 COLA. Okay, so if you're if you're under age 60 when you retire, then you have to wait a little longer for the COLA to kick in. So let's look at bullet point number 1 there. So if you're under age 60 on the first anniversary of your retirement, first COLA begins the employee's 60th birthday if earlier than the 3rd anniversary of their retirement. Here's an example. So if somebody retires this year at age 58, that means that they will turn age 60 the year after next in 2023. So anyone who retires this year at age 58, their COLA will begin in January of 2023 because that's the year in which they turn age 60. Okay, so 2023 in that example, age 58 this year, retires this year, COLA starts January of 2023. Now let's say they look at bullet point number 2. So if someone is, let's say age 52, they're 52, they have their 30 years of service and they retire this year. Well, they're going to have to wait until their 3rd year of retirement. So if they're retiring this year at age 52, their COLA will kick in at January of 2024. So like I said, depending on the age you are at retirement, that defines when your COLA is going to start. So the shortest wait for the COLA is the January after you retire, provided you retire by November 30th of that year. And the longest wait for the COLA is 3 years after you retire. So a couple of notes about COLA. So as I was just saying, you will begin receiving the COLA in the January of the year that you become eligible. Now, employees that are receiving a money purchase pension, that is a limited pension. So if you're receiving a money purchase pension, that small amount that I was talking about earlier, and it's not for life, it's only for a certain number of years, then those employees are not entitled to a COLA. Also not entitled to a COLA are surviving spouses. So if you're receiving a surviving spouse benefit, you're not entitled to a COLA. And also any children that are receiving a survivor benefit until the age of 18, they're not entitled to COLAs either. So the COLA is only for you, the member, and if you are receiving a lifetime pension benefit, which the majority of you will be receiving. Okay, so let's talk about surviving spouse benefits. So for a member who dies while they're actively working or after they've retired, generally speaking, the survivor benefit is half of whatever the employer was making at the time of their death. There are some minimum amounts also for surviving spouse benefits. If a member dies while they're actively working, and if they had at least 5 years of service at the time that they passed away, then the surviving spouse is entitled to at least $800 per month. And if a member passes away after they've retired and they retired with at least 10 years of service, then once again, surviving spouse is entitled to at least $800 per month. And for a member that dies while they're actively working or after they've separated from service, then the spouse is entitled to at most 50% of that employee's highest salary. Okay, so now let's talk about disability benefits. So there are 2 types of disability benefits offered here at the fund. There's what's called ordinary disability or non-duty disability, an injury or illness that is not related to your job. So if you apply for and are approved for ordinary disability, you're entitled to 50% of your salary. And there's also duty disability, an injury or illness that is related to your job. Then that is, in a situation like that, you're entitled to 75% of your salary. And what happens in a case like that is that you'll receive 66 2/3% of your salary from workers' comp, and then our pension fund will pay you 8 1/3%. So when you combine the 66 2/3% with the 8 1/3%, that equals 75% of your salary. Now, an important note about disability benefits. Now, in order to receive pension credit while you're on disability, you have to apply for benefits with our office. I've spoken to several members over the years who fortunately weren't aware of this, where they applied for disability benefits through their employer, but they never called us to apply for disability benefits. And there's a big reason why this is important. The reason is that disability benefits can only be retroactive to 1 year from the date that you apply. So here's an example that I dealt with where I had a member who called the office. I spoke to her. She had been on disability with her employer for the last 3 years, but she never called our office to apply for disability. So the unfortunate news for her was that she was still able to apply, but she was only able to have her benefits be retroactive 1 year from the date that we received the application. So if she's been on disability for the last 3 years and she can only have the benefits go back 1 year, she's lost out. She lost out on 2 years of pension credit and 2 years of disability benefits from our fund. And I don't know about you, but 2 years of service sounds like a lot to me. So you don't want to be in that situation at all. So if you find yourself applying for disability through your employer, make sure you contact our office, ask to speak to one of our disability representatives, and get the process going with our office as well. Very important. Okay, so now let's talk about how a pension is calculated. So if you notice me perking up a bit, it's because I used to be a math teacher and this kind of stuff I find exciting. So here's the formula to calculate your pension. We take that 4-year final average salary, we multiply it times your years of service times 2.4%. So that is how your pension is calculated. And if you wind up in a situation where, once again, if it's age 55, for example, with 20 years of service, that's a case where your pension would be reduced. So I'll show you a couple of examples coming up of a reduced pension and an unreduced pension. So let's first talk about the final average salary. So let's look at this example, a member that separated this past February 28th of 2021. So they only have a half of a year of service for this year because they didn't work 6 months and get that full year of credit. So in order to calculate their final average salary, as you see here, we don't just use 4 years, we have to use 5 years technically, where we've got to treat 2021 as a half year and we treat 2017 as a half year and kind of combine these two together to make that into a full year. And then we have our other 3 full years of 2018, 19, and 20. And then that equals a final average salary of $4,000 per month. So keep that $4,000 amount in mind. I'm going to use that in a couple of other examples. Second case of calculating a final average salary. This member retiring next week. They're retiring June 30th. So in a case like this, as you can see, we actually have now 4 full years, 2018, 2019, 2020, and 2021. So this time I don't even need 2017 in this example because I've got my 4 full years right there. And in this scenario, the final average salary averages out to $4,500 a month. I'm going to use that $4,500 in these next couple of examples also. So here's our first case of examples of calculating the formula pension. So let's see our first case up here. Member retires February 28th of this year. They're age 60 with 25 years of service. So we take that final average salary of $4,000 times 25 years of service times 2.4%. So this member is entitled to a monthly pension of $2,400 per month. Now, another question I get a lot is people ask, well, what percentage am I going to get for my pension? Here's how it's calculated. You take the age, you take the years of service times the 2.4%, and that gives you 60%. 25 times 2.4 is 60. So in this example, this member is receiving 60% of this 4-year final average salary of $4,000. So that's where that percentage comes from. That's how that's calculated. Next thing, we see a member that is retiring on June 30th. Once again, age 60 with this time 25 and a half years of service. Now I'm using that second final average salary I had of $4,500 times 25 and a half years times 2.4%. This equals a monthly pension of $2,754 a month. So this member is receiving 61.2% of their final average salary. And that comes from 25 and a half times 2.4. Now, once again, talk about the reduction that I mentioned earlier. So if you separate from service between the ages of 55 and 59, and you have at least 20 years of service, but less than 25, your pension is going to be reduced 0.25% for each month that you are under age 60. So this is a chart that kind of really explains that. So as you see here at the bottom, if we bear with me, let's do a bit of math. If you're age 55, you are 5 years away from age 60. 5 years is 60 months, because of course, 12 months in a year times 5 years is 60. A quarter of 60 is 15. So the maximum reduction on your pension would be 15%. So you see that right here at age 55 with 20 years and less than 25 is going to be a 15% reduction. And then at age 56, 12% reduction, age 57, 9%, age 58, 6%, and age 59, 3%. And then there's no reduction, as you can see, at age 60. The reduction is only between the ages of 55 and 59 with 20 years of service, but less than 25 years. So the closer you are to age 60, the smaller that reduction is going to be. So let's see some example. Let's see an example here of with the reduction and without. So top example, February 28th retirement date, age 55 with 20 years of service. So there's going to be the reduction here. So the final average salary, as you see, $4,000 times 20 years times 2.4%, but we have to shave 15% off of this benefit because it's going to be reduced. So the reduced pension here is $1,632 a month. Now in the example you see underneath that, age 60 with 20 years has no reduction because once again, at age 60, there is no reduction on your pension. So this time it's the same formula, just without that 15% reduction. $4,000 times 20 times 2.4 is $1,920 per month. So with the reduction, they're going to receive 40.8% of that $4,000 final average salary. But without the reduction, they're going to receive 48% of the $4,000. So you see the difference there with the reduction and without. So the reduction takes off about almost $300 a month in pension. And let's see another example with and without a reduction, retiring this June 30th, age 55 with 20 and a half years of service. So once again, their benefit must be reduced. So final average salary of $4,500 times 20 and a half years of service times 2.4%. Once again, taking off 15% of this is $1,882 a month. And then similar scenario, but this time age 60, so no reduction, $4,500 times 20 and a half years times 2.4%, $2,214 per month. So once again, you see that difference of the pension with the reduction and without. Okay, applying for benefits. So after you have informed your department that you are resigning, now this is important because we handle retirement, but you will handle resignation with your job once you know that you want to retire. A common misconception that members have too is that they think if they turn in the retirement application to our office that we're going to let them know, let their employer know that they're retiring. It doesn't work that way. You have to handle the resignation process. So it is strongly recommended that you submit a retirement application to our office 2 months prior to your retirement date. The reason for this is that if there's something missing in your application or something wrong with it, something that needs to be corrected, you have time to fix that and you're not scrambling to do that very, very close to your final date of work. Okay, now this is also an important note. Employers who are eligible for pension benefits upon separation from service who do not apply for benefits at that time will have a pension effective date no earlier than 1 year prior to the date their application is received by our fund. So you might be saying, well, what does that mean exactly? I'll give you an example. So let's say that someone is age 60 and they have 20 years of service. So they're eligible for retirement. But let's say that they separate from service, but for whatever reason, they choose not to apply for pension. They just don't do it. They think that they have money saved, or they go get another job and they just think, well, I don't need to apply for pension right now. So let's say that instead of applying at age 60, they come back to us 3 years later at age 63 and want to apply for benefits. In a scenario like that, they would only have a benefit effective back to age 62. Because as I just said there, your benefits in this kind of scenario where you separate from service, you are eligible for pension, but you choose not to apply, we only go back 1 year from the date that you apply. So in this example, if someone applies 3 years after they could have applied for pension, and then they lose out on 2 years of benefits. So don't be that person. Don't fall into that situation of being on the phone with me and saying, well, nobody told me and I didn't know. And then I asked them, well, did you call our office before you separated from service and talk to a counselor and get information? And of course, they say no. You don't want to be that person. So if you are planning to separate from service, if you are thinking about retirement, contact our office. Talk to a counselor, get a pension estimate, learn what your options are. You do not want to be in the situation of being someone that says, I didn't know, no one told me. It's not a good place to be. Okay, so there are several supporting documents you've got to turn in along with your retirement application, along with the forms. So I'll go through them here. You've got to submit proof of your resignation. So very close to your last day of employment, you're going to get a letter from CPS that states that your resignation or retirement is accepted and approved, and it's effective whatever your last day is going to be, June 30th, whatever your last date is going to be. We need a copy of that letter. You'll also need to submit copies of a photo ID, a driver's license, or a state ID. If you're currently married, a copy of your marriage certificate. If you have been divorced or are widowed, you must turn in copies of the divorce decrees or death certificates. Another common misconception is some members think that they only need to turn in divorce decrees if they were divorced while they worked for CPS. That is not true. If you have been married 4 times, you've got to turn in all 4 divorce decrees. So it doesn't matter when you were divorced. If you've been divorced, period, you've got to turn in all the divorce decrees. And if you are currently married, we need a copy of a birth certificate or a passport for you and your spouse. If you're not married, we just need it for you. And if you are married, we need a copy of your Social Security card or the Social Security cards of you and your spouse. If you're not married, then just the Social Security card for you. And if you choose to sign up for direct deposit, which I strongly recommend, we will need either a voided check or a letter from your bank that is on bank letterhead and signed by a personal banker or signed by a representative of the bank. Okay, and the civil union requirements are very similar to the marriage requirements. Birth certificate or passport for the spouse, a civil union license, and a civil union decree or a death certificate. Like I said, just like being married, very, very similar. Okay, reciprocal considerations. If you do plan to retire reciprocally, you must indicate on the retirement application of each fund that you plan to retire reciprocally, because you're going to need to complete retirement application with our fund and the reciprocal fund or funds. So you've got to indicate on each application that you plan to retire under reciprocity. And you must meet the vesting or the retirement eligibility requirements of each pension fund. You can't meet only the requirements of one pension fund. You've got to be able to retire from both pension funds. Okay, the reversionary annuity. So this is a very rare thing, probably only out of tens of thousands of retirees, there's probably only a handful of them that sign up for this. So if you would like to have, upon your death, a pension benefit set up for an immediate family member, a spouse, a child, a sibling, or a parent, and it has to be somebody in that category. So if that's considered immediate family. So grandparents, aunts, uncles, cousins, they're not eligible for this. If you want to set up a death benefit for them, it's called a reversionary annuity, a monthly pension benefit, I should say, upon your death. It's called the reversionary annuity. Now, there are a couple of big conditions to this, and I think these are the reasons why very few members sign up for this. The first one is that it involves you choosing to reduce your own monthly pension benefit. Now, typically when I say that to people, they say, never mind, I don't need to hear anything else about it. But you would have to reduce your own benefit by at least $50 and no more than $400 a month. So that would be coming out of your pension check and set aside for this person upon your death. And so you could choose to elect the reversionary annuity. Now, like I said, there are some more big stipulations to this. One of them is that if you choose to elect this, there's a form you would need to complete. That form has to be in our office prior to the effective date of your pension. So for example, if a member is retiring next week, June 30th, and they want to elect the reversionary annuity, if they retire June 30th and their pension effective date is the very next day, July 1st, if they submit the form to us July 2nd, it will not be accepted. So the form has to be in before your pension is effective, before the effective date of your pension. Another stipulation is that if, and the few times that I have seen this, it's been for an immediate family member that is disabled, someone that can't take care of themselves. If that reversionary beneficiary, if they pass away before you do, so if you outlive that reversionary beneficiary, and let's just say, for example, you've had $300 a month coming out of your pension check for the last 2 years, you don't get that money back. Okay, so yeah, that's a big stipulation right there. Another big stipulation is that you must survive, you must live at least a full 365 days from the date that you signed that form. So not just 1 year, you must last a full year, at least 365 days. If you were to pass away before a full 365 days have passed since the date that you signed and turned in the form, then the reversionary annuity does not go into effect. Another note about the reversionary annuity is that, let's say, for example, you choose to have $300 a month taken out of your check for this. That doesn't mean that that beneficiary is going to get $300 a month. There's a formula involved in the calculation of how much that reversionary beneficiary would receive upon your death. So that calculation is based on the age of yourself and the age of that reversionary beneficiary. So that's a formula that we would calculate. So if you want further details on this, you can absolutely contact our office and we can talk to you about it. But I think you get the idea as to why many people don't elect the reversionary annuity. Okay, so to kind of start to wrap things up, so we've got another thing I want to mention is what's called a membership record. So all members of the fund are required to have a membership record on file, and most members do, but occasionally I'll talk to someone who doesn't have one on file, and they're important for two reasons. The first reason is that the last page of the membership record, and it's about a 4-page document, it has some basic demographic questions, but the last page of the document is the designation of beneficiary form. So that form is used to set up death benefits. So that has to be notarized in order for it to be valid. So I just want to make a note of that. So it sets up your designation of beneficiary form. And also another important thing is that if you were to call our office and request a pension estimate or your account balance or any information on your account, we could not enter that request if you don't have a membership record on file. So like I said, most members do have one on file. If you're not sure whether you do or not, absolutely call our office and we can tell you whether or not you have a membership record on file. And if you don't, then we can either mail it to you or we can email it to you, or you can go to our website and obtain the form there. Okay, so please absolutely contact our office with any questions that you do have. Like I said, contact us, get a pension estimate. If you're planning to separate from service, review your benefit options, or if you just have questions. So absolutely contact our office. Our phone number is 312-236-4700. Our fax number, 312-527-0192. We're available to serve you Monday through Friday from 8 a.m. to 4:30 p.m. You can also submit questions to us via our website, www.meabf.org. If you go to our website, you'll see an option on the left side that says contact us. And it's a form you can just fill out right there on the website. You put in your name, your email address, and your phone number and submit your question. And then we'll answer that question as soon as we can. Okay, so I want to thank everyone for listening. I hope you have enjoyed the presentation and learned a lot. I'm going to go ahead and answer some questions here that I've received during the presentation. So let's see. First question I see here is, how many years do you need to retire at 55? How much of your pension will you get? If you're single, can you get the spousal portion of your pension? So I'll kind of work in reverse here. So as I mentioned earlier, as long as you are legally single at the time that you separate from service, once you retire, you will receive a lump sum of your spousal contributions. You will receive that as long as you are legally single at the time that you separate from service. So let's see. Also, how much of your pension will you get? Well, I can't answer that. That's specific to every member. You've got to call our office, speak to a counselor, request a pension estimate. So there's no general answer to that question. It depends on how many years of service you have and your salary. So call our office. We can definitely work up a pension estimate for you. How many years do you need to retire at 55? Well, at 55, if you have at least 10 years of service, then between 10 and 19 years, you're eligible only for the money purchase benefit that I mentioned earlier. Like I said, that's that smaller benefit that tends to be only a few $100s a month. So in order to be eligible for the minimum formula, you need at least 20 years of service at age 55. And with the 20 years, you're eligible for a reduced benefit at age 55. And with 25 years of service at age 55, you're eligible for an unreduced benefit. But definitely contact our office. Next question. Let's see. All right, good evening. I would like to get info pertaining to repurchasing some of my years back from a previous Illinois employer of IMRF South Suburb. So now that doesn't fall under our pension fund. So you would need to find out which pension fund from that list I mentioned earlier, which pension fund those years were under, and contact them and regarding repayment of that refund. You would only contact us regarding refund repayment if it was time under our pension fund. So you've got to contact, it looks like it's IMRF. You need to call IMRF and contact them about repayment of pension. Good question. This is a good one. Hi, Ellen. What's an unreduced pension? Well, it kind of falls into those examples I mentioned earlier. If you're at age 50 with 30 years of service, your benefit, whatever that benefit is, and it's going to be calculated just like I showed you earlier, whatever that benefit is, it's not going to have that reduction on it. But if you are 55 years of age when you retire with at least 20 years of service, but less than 25, you're going to have that reduction that I mentioned earlier of 0.25% for every month that you are under age 60. But if you are 55 with 25 years of service, there's no reduction. And if you are age 60, period, there's no reduction at age 60. It's only between the ages of 55 and 59 if you have at least 20 years of service, but less than 25 years. Another question from Mary. Hi, Mary. When we receive our projected monthly pension, is that a separate amount for those of us who switch to midlife and also will have a Social Security benefit? Is the amount we receive monthly already taxed? Great questions. So yes, this pension is separate from your Social Security benefit. Now, because of these years that you've worked for CPS and have not contributed to Social Security, you can fall under something that's called the windfall provision, where your Social Security benefit can be affected by your pension. Your pension is not affected, but your Social Security benefit can be affected. Everyone's situation is unique and different. So what you've got to do is contact Social Security and speak to them about any potential reduction of your Social Security benefit. And is the amount we receive monthly already taxed? No, it is not. You will pay federal taxes on your pension, but under the current laws, you don't have to pay any state taxes here in Illinois, but you will have to pay federal taxes on your pension. And in the retirement application that you complete, you will choose one of three options for your federal taxes. Option one is you can choose to not have any federal tax withheld monthly and just deal with the taxes when you file your taxes the next year. That's one option. Option two is to file either single or married and claim any number of exemptions. And then option three is to just have a flat amount taken out every month. My advice is always to discuss this with your tax advisor because they know your financial situation and they can answer those questions for you. Another question from Judy. Hi, Judy. What happens to spousal benefits if spouse is deceased? Well, like I said, as long as you are legally single at the time that you separate from service. If you are a widow, that counts as legally single, and you will receive upon retirement that lump sum of the spousal contributions. The only case in which you retire in which you would not receive the lump sum spousal contributions is if you are married at the time that you separate from service. We'll be able to get a copy. Oh, hi, Sharon. We'll be able to get a copy of the slideshow after the meeting. If you contact our office, ask for me, I can send you a copy of the presentation. And there's a chance that we may be posting it on our website. I haven't gotten any official word on that yet. It's not my decision, but certainly you can contact me at the office, I would say next week. And then definitely I can email a copy of the presentation to you. Another question from, I hope I'm pronouncing this right, it's either Tania or Tanya. I apologize if I'm mispronouncing that. Can I pay more into the fund and retire earlier? That's a very good question. Unfortunately, no, you can't. The contributions are set by law. So by law, you've got your 9%. If you're tier 1 or tier 2, you've got your 9% contribution. And then if you're tier 3, you've got that 12% contribution. So no, you cannot pay into this more and retire earlier. What you can do is pay into a deferred compensation plan and have that as a supplement to your retirement. Hi, Anna. You came in late to the meeting, and can you speak with me afterward? Or you could. Oh, so what you can do is you can call the office tomorrow and just ask to speak to me, and I can absolutely speak to you and review your pension benefit options and answer any questions that you have. Question from Tennille Evans. Hi, Tennille. Can you pay back your refund and get credit back for all your years of service? Potentially, yes. Yeah, if you've taken a refund of contributions from our fund, and then you're back working for either CPS or Reciprocal Fund, you do have the option of paying back that refund. But like I said, you've either got to be working for CPS, and you'll be once again a member of this fund, or you've got to be a member of a Reciprocal Fund, and you've got to establish at least 2 years of service credit upon your return. As long as you've done that, yeah, absolutely, and you can contact us, our office, and yeah, we can definitely send you an estimate. I'm sorry, not an estimate, a bill. We can send you a bill for the cost to buy back that refund. Hi, Sandra. How much is the spousal refund? Well, there's no specific amount that everyone gets. It depends on how much you've contributed. Okay, so yeah, you can call our office if you want to know how much you currently have in your spousal contributions. Just call our office. We will send you a letter with that information. Another question from Anonymous. Hi, Anonymous. So if you contributed to both CTPF for 30 years and are currently contributing to this fund, and I'm 56 years old and the board picked up 1 year of contribution, what would you suggest I do? Continue for at least 2 more years? I can't answer that like this. We need to look at your account and review your options with you, and maybe even do what's called a reciprocal pension estimate. So contact our office. So yeah, absolutely, we can look at your account and we could get into that further. But without looking at your account, there's no way for me to answer that question right now. Let's see. You are welcome, Catherine. Not a problem. See, another one from Anonymous. Hi, Anonymous. Will there be Spanish versions of this presentation, or are there Spanish-speaking staff that can help decipher this challenging information? Yes. Well, yes to the second part of that question. We do have Spanish-speaking counselors, one in particular. So if you call the office and ask to speak to Gerardo is a Spanish-speaking pension benefits counselor. And when it comes to the retirement application, there is Ruby, and Ruby is fluent in Spanish. Okay, hi, Anonymous. What are our health insurance options after retirement? This is a very good question. Now, unfortunately, through our office, there is no post-retirement health insurance offered through us. If you are under 65, you have the option of going on COBRA through your employer, or you can choose to simply go to the Obamacare website, the healthcare.gov website, and you can choose to sign up for your own plan. That's if you're under 65. Another option could be you could choose to, if you are currently married, and if your spouse has insurance, you could choose to potentially look into going on their insurance as a dependent. So that's an option too. Now, if you are 65 years of age or older when you retire, COBRA is not an option. You can only be on COBRA if you are under age 65. So Medicare is the main option for members if they are 65 or older. So a few months before you retire, you want to, if you're 65 or older, if you haven't done so already, you want to contact Medicare and apply for Part A and Part B as in boy of Medicare. So you want to get Part A and Part B. What you also should look into, this isn't mandatory, but it's a really good idea. You should also look into a Medicare, either a Medicare supplemental plan or a Medigap plan, or a Medicare Advantage plan, because Part A and Part B as in boy of Medicare only cover 80% of expenses. And so it's a really good idea to pick up a plan to cover that other 20%. Okay, let's see. Hi, Anonymous. Is there a penalty in years of service when someone takes a leave of absence for maternity leave? No, there's no penalty involved. And so in fact, going back to the service credit, the way service credit is counted, as I mentioned earlier, if you work 6 months in a calendar year, you get a full year of credit. So let's say you take maternity leave for 3 or 4 months. Well, that's okay, because if you work six months already, you already have your full year of credit. So there's no kind of penalty for that. No. Let's see. If retiring, hi Paula, if retiring is 63 years with 30 years of service, how much would medical benefits cost? That's a question that I can't answer specifically. What I can do is, once again, just mention that you can either look into your applying for COBRA with your employer, or you can look into getting your own insurance plan. There's no one set cost particularly for that, but like I said, you need to look into one of those two options, looking into COBRA or looking into the healthcare.gov website and getting your own insurance. Or as I mentioned earlier, again, if you are currently married, you could potentially look into becoming a dependent on your spouse's insurance. Hi, Anonymous. Can you pay back a refund after 90 days to get years of service credit? Well, no. Well, it depends on what we're talking about. If you're talking about 90 days after you separate from service again, no, you can't. Okay, like I said, so if you take a refund of contributions, you're back working for CPS and you want to pay that refund back, you can pay it back as long as you do so within 90 days of your next separation from service. So as long as you're still working, you're fine. But if you separate it again, you only have 90 days after that second separation to pay that refund back. Hi, Helen. Can you buy back time if you had a break in service? Unfortunately, no, you can't. You can only buy back service time in really one of two ways. There's the refunded service that I mentioned earlier, or there are rare cases in which a member was working for CPS or for the city, and they were working, but they weren't making pension contributions. This typically only happens with people who were working back in the 1980s, for example, back when the laws were different and it wasn't mandatory to contribute to the pension. So in cases, rare cases like that, we can request a work history from CPS and then see if that time is on the work history, the time that you worked but didn't pay into the pension fund. In a case like that, you can potentially buy back those years or that service time if it appears on the work history. But if you just have a break in service, no, unfortunately, you can't purchase any service time for that period. Hi, Maria. Thank you for all the information. You're welcome. I assume that means age 60 and 25 years of service. When is your best month to retire to obtain COLA benefits sooner? Well, like I said earlier, if you're age 60, your best bet is to retire no later than November 30th of that year, whenever that is. Because as long as you do that, you're entitled to the COLA the January after you retire. But if you are age 60 and you retire in December, you're going to miss out on the first year of the COLA. So just make sure that you retire by November 30th, whenever that is. Hi, Susanna. Do we have access to make an appointment in person regarding retirement information? Not just yet. The office has been closed to visitors due to the pandemic since March of last year. I think we're getting closer to reopening the office to visitors, but I don't have a definitive date for you on that. But I'm going to say if you call the office, I would say in another month, maybe 2 months, things will probably have changed and you will probably be able to make an appointment to come in and see us. But I don't have a firm date on that yet. Hi, Judy. I have an estimate benefit letter saying I will be credited with 20 years on June 30th. What would be the difference if I retire November 30th? Great question. There is no difference. So because as I mentioned earlier, you gain your full year of service in June. So you this month, you have your full year of service already. So there really is no difference between you retiring now versus retiring in November. The pension amount is going to be the same. As I mentioned earlier, that's why a lot of people retire June 30th. Next month, I am going to have so many pensions to process, probably 3 or 4 times what I normally have to process, because so many people, hundreds of people retire every year on June 30th. It's overwhelming. Hi, Anonymous. If I receive a raise that is retroactive for the last 4 years of my service, will that be calculated into my pension? Yes, if that raise shows up in our payroll or on your payroll, and you make contributions on that raise. So if you receive a retroactive raise and you make contributions, or we receive contributions on that raise, then yes, then your salary will be updated, your salary will be recalculated, and then of course that would mean a higher pension. So yeah, we've got to receive that retro in our payroll, and there have to be contributions on that retroactive raise. Hi, Carmen. What if you separate from service at age 47 with 23 years and do not withdraw funds? What happens to the contribution? So as I mentioned earlier, you have a couple of options. You can, if you want money right away, you do have an option of taking a lump sum refund of your contributions. But like I said, you do forfeit your years of service in that scenario. But it sounds like you don't want to do that. And that's a smart decision to hold on to those years and those contributions. Well, the contributions just stay here. And then you would be eligible either in this scenario, you could take a pension at age 55. Now, it would be a reduced pension at age 55 because 23 years of service falls between that window of having 20 years but less than 25. So you could take a reduced benefit at age 55 with that 15% reduction, like I showed you earlier, or you could choose to defer until age 60 and take an unreduced pension. Okay, well, 2 more. Hi, Anonymous. Can we roll over the spousal benefit to an IRA if the husband is deceased? Yes, you can. Absolutely. So there is a form to complete when you retire as part of the retirement application. And absolutely, if you want to roll over the nickname we give for this is called the no spouse refund. If you want to roll over your no spouse refund, you absolutely can do that. Hi, Rose. I was on disability leave for 3 months. You did not contact our office. Well, depending on the time frame of that, you may be eligible for some retroactive benefits. I would say call our office, ask to speak to one of the disability representatives, okay? All right, let's see. Last one, hi, Anonymous. How do we get in touch with COBRA benefits? That's through your employer. So talk to CPS about that, talk to payroll HR, they can direct you from there about that. So I want to thank everyone for being here. If I didn't get to your question, I apologize, but absolutely call our office, 312-236-4700, ask to speak to a benefits counselor. Absolutely, get a pension estimate, review your options. All right, so Jack, if you are there to close things out.
Okay. Lateef, thank you very much for all the information you gave all the members and the contributors to the fund. It was very useful and informative. I'd like to thank you, and I'd also like to thank the officers of the Chicago Teachers Union for sponsoring this. President Jesse Sharkey, Vice President Stacy Davis Gates, Recording Secretary Crystal Williams Hayes, and Financial Secretary Maria Marino. Also, if you need to contact me, if you'd like to, I'll give you my email. My email, if you have any other questions, it's jacksilver1@gmail.com. jacksilver1@gmail.com. If you were interested in being a member of the Pension Insurance Committee, I'd love to have you on my committee. We meet monthly, and we have informative sessions, and we plan with the different funds, the educational sessions. So feel free to contact me. And again, I want to thank you again for showing up. And you have the emails in you have my email, and you have the meabf.org email. And also, if you want to apply for the committee, you can go to the website, or you can contact me. You go to CTU and you go .sh/committees. Okay. Well, thank you again for showing up. I know you made an effort to come today, and I really appreciate the effort you're coming out. And we look forward to hearing from you again, and we wish you all a great summer. Okay, be well.